for a lot of New Zealanders, health insurance is a peace of mind. And then somewhere around 60 or 65, it can start feeling like punishment for aging. Premiums jump, and you're probably wondering, am I actually getting ripped off? But also at this time, this is usually the age where you're finally meant to be enjoying life, traveling, starting new hobbies, spending time with family, definitely not sitting on a wait list for 2 years waiting for a new hip. So what should we do with our health insurance after 60? Do we keep it, fix it, or ditch it? I'm putting that to my guest, Abby Woollaston, a risk specialist and financial advisor, the director of Redress Advice. Abby helps people structure cover in a way that's sustainable over the long term. And she's also very honest about the traps people fall into, especially as they get older. I'm Hannah McQueen, and this is The Next Bit. So, Abby, I'm going to be a little more direct with you because you're a friend.
Yes.
But let's be honest, when we think about insurance advisors, most of us get a bit twitchy. We kind of think, whose side are you actually on?
We're firmly team customer. I see that we are in the service of our clients, both at the start when they need help navigating the overwhelm that is the insurance market, putting together what they need, and most importantly, being their advocate when they need to claim, being the in-between between them and the insurance company to get the outcome we want. Obviously, we need a market to work in those, so we do have good relationships with the insurance companies so that we can get the outcomes and the solutions we want for our clients. We're not tied to any one company or have any contractual arrangements to put certain amounts of business with any one provider or get paid any more by anyone over the other. So we are firmly independent, firmly team customer.
Okay, so let's cut to the essence of this episode. Yeah. As you get older, your premiums skyrocket. And we're talking about health insurance specifically.
Yes.
So we were looking at a table earlier where at 60, let's say it's around 500 to 600 seems to be kind of the standard monthly premium. By the time you're 70, that's doubled. So that's kind of around 1,000, in some cases 1,100,
depending on the structure of what they've got in place.
Yes. So if you haven't taken a proactive, nuanced or customized approach to your insurance, which I think would be most Kiwis because not all of them work with you.
Yeah, set and forget is definitely what we tend to see.
Yep. So that feels pretty extreme, that lift in premiums. Most people would say, I'm getting ripped off.
Mm-hmm.
What would you say to that?
Well, the mechanism behind it is that insurance companies, through their actuaries, they work out insurance premiums based on, for every dollar that they receive in premiums, how much of that are they going to be paying out in claims. And so they base that on their claims history. So there is actually a mathematical formula behind those skyrocketing premiums. And I think that for the over 60 cohort, there's a double whammy happening at the moment because across the market for everybody, for 20s, 30s, 40s, we're seeing skyrocketing medical premiums, the highest we've ever seen because of medical inflation, because of the COVID lag where people weren't able to be seen for a couple of years. Now everybody's in catch up. So there's almost like a double whammy happening at the moment where your premiums have always gone up as you've got older, but you've also got this industry phenomenon happening. So when you're seeing those premiums skyrocket in that age range, it's because that's literally what the claim statistics show. That's what's happening as far as how much the companies are having to pay, and so they then need to fix the ratio. And the ratio, I think we looked at it last night. Depending on what source you look at, it can be anywhere from 70 to 80%. That if for every dollar the insurance companies receive, they'll be paying that out in claims. And for certain companies, it was as high as 90-something%, wasn't it? So that's the ratio. And so for those that older group, that's how much their operations and their treatments are costing in the years leading up to them paying that premium. And so that's what it's based on.
So let's just try and unpack that just so that the listener can understand it. So if we were paying $1,000 a month, I'm trying to choose a number I can do in my head.
Yeah,
$1,000 a month. and we're doing that for 12 months, right?
Yeah,
so we're going to
12 grand.
12 grand. But of that $1,000 a month, on average, so this is using the actual statistics, the insurance company is going to pay at least $750 of that, maybe as much as $900 a month in claims over time for use.
On balance, yeah.
On balance.
And some clients won't use that much and some will use more. So that's it. So it's
that's the medium.
And I would also just qualify when you talk about clients paying double that. So what, $1,000 a month once we would never have any of our clients paying that much for medical, because it just, when we look at a client's situation, we're looking at the whole picture, and insurance just being one tool in that. So I was looking at our premium statistics for that age group. We would want to be keeping it to $300 to $400 a month.
And we're going to talk about how we do that, because that's a really cool little trick that you've got up your sleeve.
Because it's too much of the weekly, monthly budget being channeled into something that they're not going to be able to extract the full value out of.
Yeah, because if we are paying $1,000 a month, and Mark Leishman, my co-host, he was telling me that that's what he was having to pay a month, like that. That's just
it's nonsensical. Yeah, and there's better.
That is half your New Zealand super income is going on insurance. So for a lot of people, that isn't even sustainable. And if we just round out that other point, if they are paying on average kind of a minimum of 75% of what you pay them, they pay back to you in covering surgery costs
and all the other wraparounds.
The wraparounds. There's an argument that says, well, if I was to self-insure, I would save myself maybe that 25% on average. But there's a whole lot more to that, which we're going to go through as well.
There is, because it doesn't take into account the fact that human beings aren't rational, and how many people are putting that money in every month into their bank account, and also the timing aspect, because if you decide you're going to do it now, you never know when that big $30,000, $40,000 operation is going to happen, and have you saved enough in time for the operation?
Yeah, so just to unpack that, if we were paying, when we were kind of looking at some average data points, the average cost of a surgery in New Zealand for the over 60 cohort is between $20,000 to $30,000. So the argument that I was running, as we were arguing about this last night, so it's always fun.
There's a bit of robust exchange.
Is that, well, if you're paying $1,000 a month for 2 years, instead of paying that insurance premium, you could have saved $24,000 yourself. And that feels like an option for some people. You countered that with a little bit of strop, and you're like, well, whoever actually saves? So that's the risk. There's a behavioural element that, are you even going to save that money if you weren't paying the policy, the premium?
And will it be enough?
And will it be enough? Yeah, because we're saying that if you do self-insure, well, ideally the operation would happen after 2 years.
And what if it's a $40,000 operation and you need $10,000 worth of diagnostics either side?
Yeah. So we're working to averages, right?
Okay,
there's going to be highs, there's going to be low, there's going to be those that are lower. But if the option of self-insuring, and we will talk about this a little bit later, if you know you don't actually have the cash flow to save that money, because that's the reality. When I was talking to Mark, it's the cash flow that's the problem, that it's the money to pay for the insurance, and whether because you can't afford necessarily the insurance, you're not going to be able to afford to put it in a bank account to self-insure. No. So that was sort of this romantic idea.
Yeah, we have to find some creative ways of funding the insurance, or a sensible way of staging down the insurance to the position where you can self-insure. Yeah. So we have to do it in a strategic way.
Yes, and I love the way that you do that, how you customise. I think there's going to be a lot of kind of richness in there for the listeners. Just kind of circling back to that one point, that we're also going to talk about the creative ways. You've got a way of beautifully customising your insurance so it can age with you.
Yes,
sustainably, but there are also some creative ways. If you can't just redeploy that $1,000 a month because it never existed in your budget to start with, then we need to think about, okay, well, how are we going to backfill you that possibly can give you a bit of flex without putting pressure on the kids, who ultimately are going to be the ones who mop it up, usually, if you've got kids and if they talk to you.
Like the sandwich generation that are having to sort their own budget and household out, and then they're also going to be slightly having to help mum and dad out too.
Yes. So We know that as you get older, one of the reasons why premiums increase, we've said that it's because the medical costs have kind of skyrocketed, but also there's a greater probability you're going to need the insurance, which just, I've got to say, totally frustrates me, right? Like you've invested in this insurance, you've kept healthy for all your life, and when you actually are likely to need it, they price it out of the water, it feels.
But what's the alternative? Because if you're paying for it yourself, it's also going to be getting older is expensive.
That's right.
Just the reality of it, isn't it?
Yeah. So it's preventative care is what we want to focus on.
Yeah, and that helps. And yes.
But if we come back to what are the main surgeries that are happening in your 60s, so we can kind of bring this to life for people.
Yeah, I think we looked at the core 5. The main, what most of the claims are going into, it's cancer, it's musculoskeletal, so we're talking about joint replacement, hips, knees, shoulders. And the thing about those kinds of surgeries is that obviously as you get older, there's a degenerative aspect. So there tends to be a cascade, especially because they're systemic conditions. So one thing leads to another. They fix a hip and then they realize, oh, actually the other hip has been overcompensating, or there's an issue with the knee now. So it tends to, when you have one surgery, you have a much higher chance of a high probability of needing to have a second and a third one. Okay. We have a lot of the gynecological and neurology type treatments. Diagnostics was a huge one. So that's where we're talking about before you can even get to the specialist to have the treatment or surgery. One of the largest the biggest quagmire at the moment in the public health system is probably the major diagnostics required before you can actually have the treatment. So we're talking about MRIs, CT scans, colonoscopies, gastroscopies, and those can be anywhere from 1,000 to 4,000 or 5,000, depending on how comprehensive the particular diagnostic is. And and cardiac, so cardiovascular type conditions. Those are the main ones.
How does quality of life play into it?
Well, massively. I mean, with cancer, I know with my own father, when he got, and that was all happening around the COVID, it can be like, let's just start at the most extreme. It can be life and death. A diagnostic that between 2 and 4 months, it can be the difference between them starting the treatment and it being too late and it having. So with my father, he felt something during when we were all in lockdown. He couldn't get in to get it looked at until we were out of lockdown, and by then it was too late and there wasn't much they could do. Whether they would have been able to do more if they'd have found it earlier, probably. So it's critical as far as the quality of life. The joint stuff is massive. I mean, I think we were talking about one of your friends has to wait 3 years for
in
her.
the public system, early 70s.
And so as far as you've been working hard all your life and now you're in a position where you're in pain and you've got limited mobility, so all that travel, all the, joining your local community and fitness clubs, which we know have a big move the needle as far as quality of life and sociability and all those things, that will all be compromised. Getting down on the floor with your grandchildren or, all those, I would say that from a quality of life perspective, the musculoskeletal stuff is massive, whereas the cancers and the cardiovascular are more the extreme end. But the gynae and the urology thing, and without, I don't know how down on the farm you want to get with some of these discussions, but if you're wetting yourself, if you're wetting yourself constantly because you've got a major incontinence issue, that's going to be, some relationships are never going to be the same again if you're wetting your pants at your Lions meeting or whatever, because it impacts your confidence and your ability to turn up in the world. So you need to get that stuff dealt with. But it will not be life-threatening, so you won't be a priority on the public system. You won't get it. You'll be waiting for so long that you'll probably die first. So that has a massive impact on quality of life.
Yeah, and speaking of my friend who's been waiting 3 years for her surgery, she calls up to see where she is on the wait list, and she's going further down, not closer to the top.
Exactly. And I got some intel about that, and without naming any sources because I don't want to get anyone in trouble. But
name and shame.
No. I'm going to be look. There's always a. They prioritize. Okay, who's going to get this treatment. Someone who's not earning a lot of money and paying a lot of tax and doesn't have young children to care for is not going to be prioritised, even if they've been working hard all their life and being a responsible citizen in New Zealand. So a person in their 50s or 40s is going to be prioritised over someone in their 60s or 70s, absolutely, for that treatment. So they'll be.
Are you for real?
Well,
aren't they supposed to assess it based on medical seriousness, not remaining?
Well, if someone
contribution,
if it's a life-threatening issue, absolutely there'll be a they'll be triaged based on. But as far as these,
musculoskeletal things
or lifestyle things, or things that aren't life-threatening, they'll be looking at the whole picture and they'll be saying, I mean, it's probably cynical to bring the tax aspect in, but we would say they have to get to work and work a full-time job, and they're also looking after children, and so they get priority over someone who may have a little bit more, their life isn't as busy as, say, someone else who needs to be on their feet more.
And when you think of, older New Zealand who are more likely to need some of these things, I know they are overrepresented in the hospital system for that. They kind of they lift twice their load in surgeries relative to population.
We saw that graph about that. We were looking at the dollars paid out for that age cohort, and it went from 40 to 60. It was exponential. Yeah,
it definitely went higher. At the same time, they've contributed to society for their whole life.
Well, exactly, yeah.
But this is one of the reasons why you've got to work out or weigh up, is there a role for health insurance? And if it is becoming so expensive, what are some of the clever things that we could be doing so that we can actually have access to that? Because I reckon if you need it, right? Like, it's so valuable if you can pull it.
You've got to be, there's no cavalry coming for you. You need to be able to be present at your own rescue and make it happen for yourself. Because if you don't know how to do it or how to leverage, again, with ACC, your insurance and the public health system, it's a hard road.
Yeah, navigating that isn't hard. I think one thing I do want to labour though isn't easy.
Isn't easy, yeah.
One thing I did want to labour is that insurance is the kind of the catch-all at the end, but it doesn't focus on prevention. They don't cover costs for preventative care. It's once something has appeared, and it can be...
You have to be symptomatic, or there has to be some kind of red flag. So when clients come to me and say, now I've got my medical insurance, I want to go and get a checkup from the neck up, and I want to get this and this and this and this and this, that's not how it works. And fair enough too, because if everybody was going out spending $3,000 or $4,000 on, just a warrant of fitness with specialists, it would ramp everyone's premiums up. So so the preventative aspect, or and certain companies will include like a $50 wellness check with your GP or at your something that's not particularly useful necessarily.
Well, let's talk about what are the useful things that we should be having within our health cover.
So what we absolutely need with our health cover. Okay, so my philosophy is that you self-insure, so you pay yourself for the little things like your GP visits. Like when I have somebody come to me and they say, I want dental and optical and I want this and I want that, and I say, look, I understand that it's nice to think that you've got something you can use and it's going to be something you can interact with often and easily. It just does not deliver the value, and it's certainly not sustainable over the long term, because, like, for example, most of the providers that include a dental or optical option, the maximum you can claim on the dental optical option is $700 to $800 a year. And so how much does a crown cost? Or I think we looked at dentures, and it can be anywhere from $3,000 to $5,000. So you're only going to get $700, and you have to pay the first 25%. So it just doesn't make sense. So you absolutely have to have surgical, hospitalization, and then non-surgical bits that are related to that. Major diagnostics, so we're talking about the MRI, not the little ultrasounds and things, but the expensive tests that will cost over, say, $1,000, and ideally access to non-Pharmac drugs. As far as everything else, self-insure for that. Even specialists in tests, which oftentimes I'll get, say, a family, like in your demographic, and they'll still be paying $500, $600, $700 a month for them and their children because they've got, say, a nil excess or a $500 excess, and they've got specialists and tests for everybody. And I say get rid of the specialists and tests, because unless there's, and see again, you can't make a blanket rule, because and this is where we have to really do a deep dive into the client situation, because if you've got a long-standing health issue where you're getting really good value out of that specialist benefit, then of course we would never cancel it. Sometimes we customize it within family members, but basically people often don't understand that even if you don't have specialists and tests as its own benefit, and that's where the insurance company will cover you to visit a dermatologist or a cardiologist or a ear, nose and throat surgeon, even if you don't have that benefit on the base plan, so the surgical and hospitalisation base plan, as soon as you reach the level where you need surgical intervention or to be hospitalised, all the specialists and tests relating to that procedure are covered, depending on the provider, 6 to 12 months pre and post. So you do still have access to specialists and tests once it reaches a certain threshold. So we just got to get our minds around the fact that we're self-insuring for the things that maybe cost up to $1,000 or so, and then anything above that, that's when we lean into the medical insurance.
And just to kind of unpack that a little bit, so the reason why we self-insure, which means we don't bake that benefit into the policy, we pay for that cost ourselves, is that on balance we're likely to pay less than what the policy will actually afford us, because it's got capped payouts. So you said for dentist or eyes, it might be a $700 cap.
Yeah.
You're paying more than $700 a year for that benefit, so it makes no sense. Even though it feels great,
it's not. Yeah, it's a nice to have.
It's a sizzle. There's no sausage.
There's been this phenomenon in New Zealand called dollar swapping, whereby people go, I'm paying $500 a month in my medical insurance. I'm going to go and see the GP every chance I get, and I'm going to get my eyes looked at, and I'm going to do this, and I'm going to get my melanoma, my mole map, and so they basically, because they want to recoup every dollar they spend, okay? And sometimes you can if you've got the time to kind of work out all the little auxiliary benefits. But what that does is when the insurance company is working to a ratio of 75%, when you're claiming 100%, when you're getting back everything you're paying out, it just pushes the premiums for the whole book for everybody up and up and up. So when you go with a solution that is more it's covering the big ticket items, but there's a responsibility to self-insure on the other stuff, the whole book is more sustainable. So there's just longevity with it.
And when you say book, just for people who aren't in the industry, so this is for
jargon.
The insurance providers,
their book of clients, so
all their
clients. Yeah, so even if, like you say, you've got a kind of policy where you're not doing that thing where because you don't have the time to go, okay, I can get $20 back for this osteo visit, or I can get this done. For all the people that do have the time to sit there and kind of, extract every little penny or dollar, you'll be penalised for the whole. So on top of an environment where there's soaring medical inflation, when you're in a plan where you've got all these little bits and pieces covered and people are really trying to get everything, your premium will also be impacted because you're in that age band.
So because you're recouping 100% of the premium paid because you're kind of dollar swapping, that means that the insurance company isn't maintaining their profit margins they need for sustainable business. So
they have to increase.
Wouldn't you know it, we all suffer.
Yeah, and
Thanks a lot.
Yeah, and even if you're not the one recouping everything, if you're on that kind of policy, your premiums will still be reflected, will still be impacted by that. So it's important to be on have the right setup. Ideally, start off strong in the way you mean to go on, but even for people who are effectively stuck, because I have a lot of people come to see me, with their parents, and they say, please help my mum because she's paying $800 a month for this policy and she can't afford it. Can we move it to the one that you've just set up for us? And I say, no, we can't, because of her pre-existing conditions. Less scrupulous advisors may, but I would never replace a policy on I mean, I don't ever, my first stance is not to replace medical insurance ever, particularly not where it's been in place for more than 5-10 years. There are still options for those people usually, though, within their policy to lean it out and make it more efficient and more sustainable.
Okay, well, let's kind of wade into that for a second, because I think a lot of people will want to know.
Mm-hmm.
I just want to clear up that the reason why you don't switch insurance providers for people, because it's always annoying if someone's getting a lot cheaper premium, is that between you starting your insurance cover and now, conditions may have presented. So that's called a pre-existing condition. And if you were to move to the other insurance provider, they would exclude those conditions which are still covered under your current policy.
That's right. And I would go one step further to say it's more than just conditions. So medical insurance is the most stringently underwritten, or in layman's terms, the checks and balances to get it in place. They're the most. They're very strict, okay? So a lot of times people get themselves into hot water when they think they didn't tell the insurance company when they were applying for it. I didn't mention the fact that I go and have osteo, like a bit of a tweak every couple of weeks. That's just to keep my back in good
well-being.
Yeah, well-being, or just to tune up. It's not just conditions you need to disclose. It's treatment. It's symptoms. Even if they don't resolve, nothing comes out of them, the insurance company still needs to know all those things, because it presents a greater risk to them of something potentially happening in the future. So,
and is there a chance that based on that shared information, they might
absolutely
preclude something?
We help people all the time that have been given poor advice and they've replaced something, and then they go to claim on the new one, thinking they weren't meaning to be non-disclose or be dishonest, because they were very honest with us. They just weren't taken through the process properly, and they inadvertently left things out because they thought, well, it wasn't a condition. It was just, I just saw this, or I just had this one test. And then when they go to claim, then the first thing the insurance company will do is get all the records. And then they say, well, you didn't tell us about this, and this. And so we're not paying because that was a pre-existing, maybe not condition, but it was there was a pre-existing dynamic there that, had we known about it, we would have put an exclusion on relating to that treatment or those types of consults. So with medical insurance, even if you've had your big toe looked at, they'll exclude it. So
if you're moving providers, but
if you're moving providers.
Yes.
So the beautiful thing about the insurance that we're talking about, and I think we covered this last night, it is what we call guaranteed renewable, which is different than domestic or fire and general insurance. Like with your house and your car, every year the insurance companies get to decide whether they're going to continue to insure you based on if you've been caught doing naughty things on the road or how many times you've claimed with them. And they say, no, look, the risk is too much, goodbye.
Yes.
Whereas with this type of insurance, once you're on risk with them and you've got a policy there, your individual claims history or their experience with you and how much they've had to pay, they can't get rid of you, or they can't ramp your premiums up based on your individual usage or history. But if you move, if you try to move to a different provider, you need to disclose everything that's happened to you, and basically in your life pretty much.
Mm.
And the difference between when you set the original one up and the new one, that whole area, you're exposed. Does that make sense?
It does.
Yeah.
So I guess the first red flag there is if someone's suggesting you move providers for health insurance, not life insurance.
It's a big red flag.
Health insurance, yeah, that is a red flag.
Massive red flag. And I always, when somebody comes to me and they say, I always start from a position of, what do they say about business partnership? Like if you're going into partnership, always start from the fact that it's a bad idea and you have to convince yourself into it being a good one. That's the same way that I treat medical insurance.
Right.
I always start going, we're not doing it. We're going to have to get to the point where I'm fully persuaded that this is a good idea.
Mm-hmm.
And the only sometimes what I'll do is, let's say someone's really keen on the non-Pharmac drugs. And do you want me to go into a bit about non-Pharmac now?
Yeah, I'll just close that other point out though. So we're saying the reason why they were excited to move, usually is because they could get a lower premium. They're chasing a discount because the premiums are getting so high without realizing there's all these unintended consequences that your previous conditions might be excluded,
Will be excluded,
all those other things. So that's a big red flag. But let's talk about other options that are available to you to start to reduce some of those costs, because it's not, we think it's about changing provider, but often it's not when it comes to health insurance.
It's re-engineering the product, but without throwing my colleagues under the bus, because there's a lot of people doing really good work in our industry. If we only get paid, we get remunerated either via a commission or a fee, and most of it, so we can either charge a fee or we get paid a commission by the insurance company. And if we charge a fee, then we can pull the commission out. But normally, historically, it's been commission. If a person comes and says that my insurance policy is unsustainable, help me fix it, they won't get paid for doing that unless that policy is put somewhere else and they get paid a commission based on the placement of the new policy. So it's not in their commercial interest to help
you rejig what you've got, because they're not going to be paid.
Because they get paid unless they've been a long-standing client and they're getting a renewal commission for the policy, and then they're obligated to take care of them and to reduce it. But there will always be that chasing of the upfront commission. So, but as far as reimagining the policy, yes, absolutely, we'll look at it. And most times people have set and forget it. Oftentimes they might have had been on a group scheme with somewhere they've worked, which is great if you can get access to that, because in New Zealand with involuntary group schemes, which means it's all so the insurance company gets all the employees, so they get the old people, the young people, the sick people. There's not the opting in thing. They cover pre-existing conditions. Okay,
Yeah.
So when you leave that organisation, you get to take all your pre-existing conditions with you on a continuation option, but you also get this premium because the employer was usually paying beforehand, right?
So let's just explain that though. So if you're part of a group scheme, like some of the bigger companies,
like Spark or Datacom or New Zealand,
Yep. So they give you, and you're entitled to some insurance. And what's good about that is even if you do have pre-existing conditions,
fully covered.
You are fully covered. So that's one way to get that cover. But when you leave that employer, that's what you're saying, you can take that policy with you.
With the pre-existing conditions.
With nothing excluded, but it's not going to be subsidised. You weren't even aware that it was subsidised, probably to the extent that it was. You can take that policy, but you're now going to cover the premiums going forward. Yeah,
usually it's a real eye-opening moment, because usually the employer's been paying the premium entirely. Sometimes you'll have to pay for it out of your salary, but it will be subsidised because it's a big scheme. But usually often employers are paying for it. So not only are they leaving and having to pay for it themselves, but they're also losing the subsidy. So it's like $700, $800, and it's but that's the point where you can start to nuance the different elements of it to make it more workable. And so we'll touch on that. But effectively, because those plans will usually have a nil excess or a very low excess, and the excess just means if you need a surgery and you've got a $500 excess, you have to pay that, and then the insurance company pays the rest. If you have a nil excess, the insurance company pays everything. So obviously the higher the excess, the lower the premium, right?
Yes.
So as far as the first things I'd be looking at to reimagine the policy would be the excess. It would be the bells and whistles that are on there that you don't need, that you can self-insure for. And even if you think you need them, if we've run the maths over 5 years, and for 95% of our client base, unless you're dealing with chronic and ongoing health issues, people will save. So I don't like the idea about the whole cancelling your insurance and saving that money for those big operations. But as far as the little things, I absolutely like that idea of going, if you look at what the specialists and tests and the dental and optical and the wellbeing module, what it's costing you versus what you're getting from it, if you were to save that money and pay for the 1 or 2 specialist visits you need that don't escalate to surgery, because we know they're going to be covered in the 6 and 12 months post wraparound, 95% of people will be winning at the 5-year mark with the savings versus what they would have been able to
benefit from in the policy.
Yeah.
Okay, so I think with the excess, that's something that I didn't appreciate, the extent that you could increase the excess. I thought it was around $500, which I kind of thought was chump change. But you can actually increase the excess up to $10,000 with some providers.
Yeah.
And the impact of that is
massive.
It can reduce your premium by 60-70%.
Well, we saw clients in that 60 to 70 age range who we were looking at under $200 a month. And so what that would mean is 10,000 obviously is a lot of money, but what it means is it's almost like a co-payment then. So you know that if you need that $30,000 or $40,000 operation, you'll pay the first $10,000 and the insurer will pay the rest.
Yeah, and if we take it back to that math, if you're paying $200 a month, so that's $2,500 a year.
You save up that bit.
And for that same 2 year, if you're having that hip operation after 2 years and you pay the $10,000 excess and the $200, that's better doing it that way than actually not paying, self-insuring the whole lot.
The whole thing. So you're kind of,
so there's a point.
You're hedging, yeah. And some providers have really got ahead of they saw where this was going. And with that 10,000 excess, there's also a waiver. So if you have a cancer, a cardiac or a stroke, they waive the excess entirely. So yes, you'll pay the excess for the hip operations but if you have a cancer or you're dealing with a heart attack situation, they waive the excess, so you won't even pay it. And also, even with the $10,000 excess, if you need a major diagnostic, because they know statistically that if we can get you seen and get you on that pathway, the outcomes are better long term for them, they'll reduce the excess to $250 for a major diagnostic. So those are wonderful ways of kind of hedging the various potential eventualities to make the premium sustainable.
Yeah, and if we compare the different insurance providers, because you're the specialist in understanding the nuances between the providers' policies.
And we work with the whole market.
You work with the whole market. But not all of them have the same excess range. Not all of them have the same ability to waive excesses under particular conditions. And some of them have different thresholds as to what they're going to pay to if something was to happen.
Yeah, the annual maximums they'll pay.
That's
so you
right.
might have, like we saw one that was a $48,000 maximum per year, which versus $500,000 or $600,000.
Yeah, so you think you've got the same cover. It certainly sounds exactly the same.
It's
health insurance
or surgical benefit, but it's capped.
Yeah, and the amount seems, when you look at it, you don't even know what you're signing, to be honest, but it seems reasonable.
Yeah.
But there are so many instances where it's not enough, and I think it's misleading where they say, well, it's capped here. They then need to, I think, accompany that statement with, and that will cover 60% of the surgery or something like that.
Yeah, because some of them, this is what that will afford you. Or what if you need to have 2 surgeries that year? That's
right. It's not relative to anything for you to actually glean to make any sense of
whether it's going to work. Yeah, and the other, can we cover the non-Pharmac bit now?
Yes.
So non-Pharmac. So you can look on Give a Little and see, people that are in dire straits with their health and they're trying to raise funds for this life-saving drug treatment. The tragedy is a lot of these people will have health insurance, but their health insurance doesn't cover non-Pharmac drugs. So in New Zealand, we have MedSafe, who's the body that determines whether a drug is safe and it's been tested. But then we have, the Pharmac, which is the funded drug protocol that you get through the public system and the private system, that those are the drugs that are funded by the government. But then for the more experimental or cutting edge, expensive, they're not only cancer drugs, but that's where we see most of them being used. They're what we call non-Pharmac. And they can be $30,000 a month.
So you can't access them in the public system.
No.
So as a result, if your insurance provider is only providing Pharmac
funded
drugs, you're limited to what's there, which kind of front page of the Herald says that they're never funding the right drugs anyway.
Or they might do like a $10,000 payment,
gesture,
which is going to pay for a week's worth of the drugs. So Herceptin's a really good example. It was a breast cancer drug, and for years New Zealanders were going to Australia to get access to it because it is on the Pharmac list, but a number of years it wasn't. So they get up to speed and will, but it takes quite a bit of time, and sometimes it will just be too expensive to. And so when you've got access to non-Pharmac drugs, when you do your little calculation about saving $800, and when you add non-Pharmac drugs to the mix, the whole thing gets blown out because we could be talking $300,000 to $400,000 for a course
of benefit that you actually are not entitled to under another insurance
unless you have
provider.
Non-Pharmac access. So some of our providers include it in their foundation product. Some providers have like a premier contract which includes it, and then other companies like Southern Cross, you don't have it in the base plans, but you can add it as a module up to a certain, you can choose it as a module, a cancer chemo module, but it will only cover the cancer ones. And there are some non-Pharmac drugs which treat liver conditions and things like that. But so it's accessible with most providers, but you have to pay additionally for it. Whereas we would try and steer our clients towards a product where it was intrinsically included and for all non-Pharmac drugs. So you kind of, because we're also future-proofing the contract then about what could come, what things that we don't know about yet that they may need.
Okay.
So the issue that we reached last night, Hannah, was, okay, we realise we need some kind of insurance, but we can't afford it. So what are the options around keeping it? Yeah?
Yeah, and okay, yes.
Yes.
Okay, so let's look at the scenario where it's come to the end of the road as it stands with your health insurance. You don't think you can afford it for yourself any longer. Let's talk about the options you've got, the levers you can pull to try and get your premiums down. And there are some levers that you would recommend and some that you don't. And I feel like some people are just trying to cut their premiums and they don't even realise the impact of that choice. Yes, it might save them a bit now, but it's an expensive mistake in case you need it.
Yeah. So the very first thing, get some advice from a trustworthy advisor, which is a bit of a dark art, you were saying, as far as when I was telling you about the value of advice. Historically, and we started off this podcast by saying people get a bit twitchy when we talk about insurance. We now have to call ourselves financial advisors, but, historically we've been insurance brokers, okay? So I would say your policy, if your policy is with AIA or NIB or Partners Life or Unimed or whoever it's with, if you've taken it out with an insurance advisor or an insurance broker, your policy will sit in their agency and they are contractually obligated to provide you with service, both in reviewing and also they should be helping you with in the event of a claim. So your first port of call would be to get in touch with them and say, hey, look, I don't want to cancel my insurance. Because sometimes not so much with our clients because we keep in touch with them very regularly. And I just say, look, before you make any decisions about anything, give me a call. But oftentimes the first time an advisor will know is that they'll get the form from the insurance company saying, your client's cancelling. And then you've got like 30 days to make sure that, because you don't want them to cut their nose off to spite their face. Contact your insurance, contact the place that your insurance policy, the agency it's with. So the company, the whether it's a Lifetime or Advice First or whoever it's with, whatever brokerage it's with, and get some help, really rattle the cages and say, I've been paying for all these years and I want to keep my insurance, but I need some help to make it workable because I can't afford it anymore, and have someone help you do that. Where you are what we call an orphan client, which is a word I hate, but basically you've been cast adrift because your broker's retired and sailed off into the sunset or something, you can call the insurance company and they have in-house people that will help you with that, or they'll be able to connect you with an advisor who can help. So first of all, get some advice. And if you can, do some due diligence on who the person that you're getting advice is. But if you're over 60 and you've talked to the insurance company about the fact you want to keep your policy but you just want to rework it, they're not going to put you with someone who's going to be trying to flog you onto a different company, okay? So first of all, advice. And you want to be looking at ways to remove the bells and whistles that are expensive and you don't need them, leverage up the excesses and understand what that's going to mean in real time if you need to claim, and when you have to pay it and what's included as far as the wraparounds with that.
Mm-hmm. So even just going from 0 excess to 5,000 in most instances could almost half your monthly premium.
Yes,
that's significant.
Yeah, that is a decent. I mean, most of my clients would be sitting in the $1,000 to $2,000 excess. But let me give you a quick example where a client has a pretty average legacy policy, but they've got a whole lot of pre-existing conditions, but they've got low maximums. But I want them to keep that policy because they're going to get their sinusitis thing done, and I get them to keep that. And then we'll top it up with a more comprehensive policy, which includes non-Pharmac and higher limits, but we put the $10,000 excess on. Might only cost them $20 or $30 a month.
And that's good in the younger group, right? Like the adult children of these people who are trying to cancel. But that makes a lot of sense. If you're
in that over 60 market and you have low maximums and you're concerned that it's not going to cover the treatment you need, you could still top it up with
we could rework what you're paying in a monthly premium
and fill in the gap with something else to cover the non-Pharmac drugs.
If you can afford the first thing is if you can afford your monthly premium, let's make sure you've got the optimal cover and don't just kind of set and forget what you've got, because you might not have Pharmac coverage, and we could plug that in.
Non-Pharmac,
non-Pharmac, sorry.
And there is also a point where non-Pharmac's not as relevant anymore, because once people get, say, past 70, because of comorbidity factors, they're not going to be a candidate for non-Pharmac anyway, really. So it's really in the 50 to 70. But where it is relevant about the top-up would be the higher maximums. If you've only got a $48,000 maximum, but you've got lots of pre-existing conditions, so you want to be able to access that cover. You want a decent, you want to be able to. So there's ways of looking at it, but
just on those maximums for a second. If you signed up to a policy and it had a maximum 10 years ago of 30,000, does that maximum lift every year, or is it?
It depends whether your policy has what they call where they pass back the enhancements of the updates and newer contracts coming in. So it's very much a case by case, but historically not often when it comes to medical insurance. That's why when we first started seeing these policies that were coming out with $500,000 and $600,000 maximums, the critics were like, oh, that's just marketing because no one's ever going to need that much. So that's just, but now we're actually going, it wasn't so
crazy.
There are pass backs in the industry, but when it comes to medical, usually not.
Okay. So we're trying to reduce our premiums. We've opted to lift the excess.
Get rid of the stuff that we don't need.
Just
keep it very lean and focused. You get some advice if you can around that, either through a qualified financial advisor or someone who's connected with your insurance company, because they are going to be, it's in their best interest that you keep the medical policy, unless you're too expensive and they're paying too much in claims. But they should. That's me.
Unless you actually need it, and then you're worthless.
Unless they actually want to offload you a little bit, and give you the gift of freedom. But no, there will be people that can help you. Okay, that's the first step. The second step is there is a point where it does become, it's not viable. Like I would like my clients to keep their medical insurance going as long as they possibly could, but probably in that mid-70, if you get that far, you're doing well if you can maintain your medical insurance. Okay, so at some point we are going to look at a staged approach towards self-insurance, towards self-insuring. And the best way to do that I think it's a wonderful idea. And I always, when I'm helping clients optimize their policy, I'm always checking what's on the horizon as far as what they've got coming up, because we'd be silly to remove bits when there's money on the table that they can extract from their policy. So having some kind of check to go, what are we likely to be dealing with in the next few years? How much of that can we manage through being proactive, and what are we actually really going to need some kind of clinical intervention with, and time the staged out around those health markers.
Yeah, so you want to do, ideally, a whole of person assessment across all domains of health to determine where are your risk areas, and if there's a chance that we do have surgery on the horizon that you weren't even aware of, best we know that before you cancel your premium policy that was going to cover that surgery.
Yeah, so it's an evidence-based decision rather than an emotional knee-jerk reaction because you're so annoyed that your premiums have gone up. But then there are other ways to think about it too as far as funding the premiums. So I think we talked about the reverse mortgage.
Yeah, so when we were talking about that, we were saying that we've got two options. You can either fund the premiums if you can't afford them, like if you do want to keep your health insurance, or if you do want to self-insure yourself. So say if you were allowing for a hip replacement for 30 grand, you need to have a facility. Like if you're going to cancel your insurance, you need to be able to pull a lever. So when you do need that money, you don't want to be waiting in the public system if you can avoid it. So if you've got a revolving credit on your mortgage, that might give you that capacity to kind of jump the queue when you need to. If you don't have a mortgage or a revolving credit, then you could get a reverse mortgage.
Yeah, reverse mortgage.
There's sort of some hooks with some of those things, but you can actually get an overdraft facility, so you're not paying interest on it
unless you need it. Apart from maybe a small bit.
There is a minimal advance. Like there's always the devil's in the detail.
There's no lunch without crust, but it's saying that it won't be as much as what the insurance premium was.
That's right. And so then if you're saying, well, it's costing you, I don't know, $50 a year in cover, and you're not going to use it, compared to paying $24,000 in a cover you don't necessarily need and has a profit margin built into it, that could be your saving grace.
At a point that makes sense medically, and have some kind of advice into that from having a consult with people that actually have the ability to kind of check where you're at, and also
like Brightly.
Yeah, because the thing that I didn't realize until you explained it to me. You can't just go off the reservation and go, yes, I want to go and see the specialist. The way insurance works is you need to go through the proper channels, a GP referral to the specialist, major diagnostic, surgery, hospitalisation. So from what we talked about, you said that the Brightly program will allow you to get GP referrals.
Or we get specialist referrals, which jumps the queue because the GP doesn't often specialise in particular domains. So our referrals are led by our geriatrician, who's kind of the highest objectively qualified person to assess the surgical risks of an older person. And so when they pass a referral through to a cardiologist to say this person's at risk of heart failure, or if
they need a colonoscopy because they've got some changes, and so you want a consult with that person or someone with that skill set to go, what are the risk markers here, and what are the likelihood of me needing of needing intervention in the next 5 years, to weigh up the cost to benefit ratio of that asset, that medical insurance that you've been paying for all these years.
Yes.
And
evidence-based decision
rather than emotional. And then the other thing I think we hit on, which would probably, it's a bit of a it's thinking outside the square, but is involving the wider family, who would not only stand to benefit from their parents being well looked after in the short to medium term, but because if they're not in a good space mobility wise or pain wise, it's gonna fall back on them. But also inheritance, like if the inheritance gets eroded because, like if things have to be pulled back to pay for treatment, that's going to have a flow-on effect to the people that would stand to get that. So there can be some capacity for other family members helping contribute to this, either in paying the premiums or the reverse mortgage.
Or having the line of credit to help them out.
Yeah.
But I guess that you want to make sure if you're doing that, just sort of my head's going to estate planning, that is recognised.
Yeah,
in
that they
wills, and so that
they have to have
recompensed
that.
for it.
They have to have there has to be some kind of letter that they get that back.
Yeah.
So I think we're covering off. We're taking no prisoners with this, Hannah. We're covering off all the bases.
What are some of the gotchas that you get when you come to make a claim? Because it would rip your nightie, man, if you have paid what would be thousands of dollars, tens of thousands, sometimes hundreds of thousands of dollars for a policy, and when you expect it to pay out, where are people coming unstuck? I mean, wouldn't that just be the worst phone call to receive?
I think it's probably, when it comes to medical insurance it's
only.
Probably to do with thinking that they've got access to things that they don't have access to. Like they think that they've got their drug funding covered, and then they find that non-Pharmac drugs
are excluded.
Yeah, or the limits, they don't realise that, yes, you've got surgical, but it's only to this level.
And that was the amount that it was 30 years ago.
Yeah,
so now you can afford an injection with that level.
It hasn't kept pace. I think that the biggest gotcha is probably around the disclosure process. So when you take out the insurance cover, what you have to tell the insurance company, whether you haven't been taken through it comprehensively when you've been doing it with an advisor, or if you've done it directly yourself online with one of what we call like a retail product, there's always fine print about needing to tell, like fine print, basically have to tell them everything. And most people don't see that, or don't read it, or don't understand what a pre-existing condition is, versus that they may want to know about all your chiropractic, physio, blood tests, ultrasounds. They want to know all of that. And a lot of people don't see that as being a pre-existing medical condition. And fair enough too, because it's not. But the insurance company wants to know all of that. And generally when you go through a direct channel, that's because it's simpler, it doesn't require advice from a qualified advisor. You don't understand the implications of not giving them that information, and then they will not cover the things that you need, because they'll say that was already in play when you took the policy out. So it's really the product not covering up to what you need it to, or you having not been covered because something was pre-existing. And it's a particularly bitter pill to swallow when you were covered previously and you changed. That's the thing that just breaks my heart, and I do tend to get quite worked up about it when those types of things happen, because I see it as fraudulent and nefarious behaviour.
Okay, 60 seconds or less, what would be your advice to someone who's at 65 or up to mid-70s? The premiums are getting more expensive. They're oscillating between, is it worth it? What would you tell them?
Look at ways of reimagining what you have to make it sustainable. Where there are gaps as far as limits or things you want access to that you don't have, explore whether you can plug those in through other products, or perhaps other initiatives like what you're doing, whereby they can manage their health trajectory through preventative stuff, rather than just having to pay a huge medical insurance premium for all the wellness type benefits that are expensive. They should just use their medical insurance for the big ticket items, and then think of other ways to deal with those other bits.
And proactively manage it to prevent the decline that was going to trigger the insurance payout. I
always say, my philosophy is, we use our insurance for things that are going to cost us over, say, $1,000 or $2,000, and then the other stuff we have to take responsibility for ourselves. Otherwise, the premium's going to be unsustainable.
Thank you, Abby.
Thank you.
If you've been set and forget with your insurances for the last 20 years, congratulations, you're like most of New Zealand. But after 60 or even older, that set and forget can very quickly turn into pay and suffer. So even if you do nothing else, please just get your health insurances reviewed, because you do not want to hit 68 or 70, need something fixed, and realize you've been paying top dollar for things that don't actually help you when it counts. Now, if this episode made you think of your parents, then please send it to them. Or better yet, listen to it together and use it as an excuse to start the conversation. It is way easier to do it now than when you were stressed, sick, or staring down a wait list. And if you want more practical money and aging tools like this, make sure you follow the podcast so you don't miss out on what's coming next on The Next Bit.